There should be a price per share, which is the current market price somewhere in there, right? So that's just your pricing per share. Right. Okay, folks. Good. Ed led me into the first topic for today, which is your project is due Monday, in case you haven't heard already. Okay. Couple of things on the project. One is once you have your numbers, and it's like 7 numbers for your company, what's your value per share, what's your pricing per share, and your recommendation, please enter those into the master list, right? Because I will need that for Monday's session. The second is for your I put a page limit on you that seems overwhelmingly tight, right? It's like 4 pages per company. And if you're wondering how the heck do I summarize a discounted cash flow valuation and get it all done within that page limit, here's what won't work. If you try to describe to me how you computed a bottom-up levered beta, you're dead in the water, right? Because I got the unlevered beta, then I went to look at these companies. I know how you got the bottom-up beta. So I'm going to, at this point in time, assume that when you say I used a bottom-up beta, I know what you mean. But the best way to summarize your discounted cash flow valuation is just take a picture of that story page, the story worksheet in your spreadsheet, or if you create your own spreadsheet, kind of a summary story page, because that allows you to tell your story about the company, connect them to numbers. Essentially, it takes everything in your DCF. And I can see what you've done. I've essentially can see your growth rate, your margins, your reinvestment, what's driving a company. It allows you to not have to spend 3 pages telling me what you're doing, and actually does it more effectively because it connects your story to your numbers right there. I can say which part of your story, so just take a picture. Don't try to reproduce it on your own. That's like 6 hours of work. We try to take each, I'm going to write it out. Just take take a picture. Don't just, with my eyes, just don't make it really small. No, it has to be readable. I don't have a magnifying glass, so I don't want to be using that. So, if need be, keep it as a full page so that you can fit this in rather than compress it into a quarter page. Okay. So today we're going to talk about the last piece of this class, which is changing value. So far, we've talked about estimating value. Today's class is about changing value. Why would you care? Because if you're a CEO of a company, your job is not to estimate value, but to increase the value of your company. If you're called in as a consultant to a company, often it's not to say, what's my value? It's to say, what can we do to make ourselves more valuable? So I'm going to set up that discussion that's to come with a few questions. The first is I'm going to draw a contrast between value enhancement and price enhancement. We've done this big deal about value versus price, right? So the question I'm asking as a CEO is, do you want to increase prices or do you want to increase value? What do you think CEOs really want to increase? Pricing. And that creates a whole lot of contradictions because I'm going to give you a series of actions and I'd like you to tell me whether they affect value. And then hazard a guess is, could they affect prices? What if I do a stock split? What does it do to your intrinsic valuation? Jack, revenue growth, margins, reinvestment, nothing's changing, right? You just change the number of units. But could a stock split affect your price? It often does, right? Why might that be? What aspect of pricing do you think? It could be psychological, which is why one could be psychological, which is if a company splits its shares, it must mean good things are coming, the price is going up, and what else? Liquidity. That may be by splitting the shares, you're attracting investors. I mean, remember when Amazon got to $2,000 per share, the 10-for-1 stock split, buying 100 shares at $2,000 per share is out of the reach for most people. So maybe it's liquidity, maybe it's new demand. It could affect prices. And in fact, studies show on average that when you have a stock split, there's an increase in price, 3 to 3%, and it's a signaling effect. Okay. What about amortizing goodwill? It's a big deal, right? You hire these accounting firms to come in on an acquisition. They tell you, well, $7 billion write-off on goodwill. Terrible news, right? Let's say your company reports tomorrow, the company you already valued, that they're impairing goodwill by $5 billion. Will your valuation change? What does impairing goodwill do? It's an acceptance of a mistake you made when? Not yesterday or today, it was 2 years ago, 5 years ago. When you did your DCF valuation, you saw that mistake play out in the numbers, right? You saw it play out in the fact that margins go up. Value is not changed by impairing goodwill. Could price change? I guess it depends on what the market reaction is. If you say I have a $7 billion loss and people say, oh my God, that's a huge loss and knock down the price. But markets actually seem to be pretty clever on impairment of goodwill. You know what the average price impact on goodwill impairment is? 0. Because by the time people do it, say, I knew that already. That happened 3 years ago. So it leads you wondering why we spend so much time impairing goodwill and doing all the accounting thing. But that train's left the station. There's an entire business built on doing it. It's not going away. What about changing depreciation methods just in your reporting books? What does that do when you change your depreciation methods just in your reporting books? The depreciation we're supposed to be using in free cash flow to the firm is actually tax depreciation, right? It's the depreciation that affects your cash flow. So if you change your depreciation just to your accounting books, you're making your earnings look much better, perhaps, but your cash flows are unaffected. And intrinsic valuation, there's no change. You're saying, who cares? You know what your reporting books look like. But if I'm reacting as a trader to earnings per share numbers, I might very well push up your stock pricing. This is amazing. This is not as common, but late 90s, a lot of companies issued what were called tracking stock. I think the New York Times actually had a tracking stock, you know, on which division? The .com division. What are you trying to do when you do tracking stock? I mean, it's your overall value as a company is the same, right? You still own it. You're trying to take advantage of mood and momentum in a segment of the market. If I were Microsoft, I would issue AI tracking stock. A ChatGPT tracking stock would probably take off through the roof. Even though the overall value, because tracking stock, you're not creating a separate company. It's not like a spin-off. You're taking your existing company, letting people trade on a piece of the company, and you're saying, trust us, right? Because that piece doesn't have its own board of directors. It doesn't have its own earnings report. It's an extraordinarily dangerous place to be, but you can see how pricing can be affected even though. What about changing your name as a company? Shouldn't affect value, right? Cash flows, growth, and risk. As we'll see when you change names, sometimes there's a pricing effect. So what I'm trying to say is when people talk about, I want to enhance value, my first question to them is, do you really want to enhance value? Because that's usually hard work. And you got to change businesses and do things in your business, or do you want to enhance prices? I could give a couple of cosmetic things you could do. And I'll wager most CEOs, if you scratch the surface, are not interested in value enhancement. They want to enhance prices. Take a second question. This, I think, is an interesting question because it cuts against the grain of what we're always taught. Let's say you've now been hired as CEO of a 4-business company. I've not been particularly creative. I've called the divisions A, B, C, and D, 4 different businesses. Let's suppose I've gone through the hard work of assessing the return on capital and cost to capital of each of these businesses. So return on capital, first business, 20% cost. So you can see which one's the loser division, right? It kind of stands out. It's division D. You now become the CEO. And you know, the first imperative when you become a CEO is you want to clear the shell. You want to divest yourself of. Which business would you divest as the new CEO? I told you it cuts it, Jackie. That's what the most common answer you'd get. Oh, let's get to the bad business. But what is the effect of a divestiture on value, Ed? How does your value get, as a company, when you divest something, it's the difference between the value and the price you get for it, right? Now you see the problem with it's a loser company, business. Everybody knows it's a loser business, including the people you're trying to sell it to. You're not going to get your capital back. This notion that if you sell something, you get the invested capital back is delusional because, you know, you're a bad business. Everybody knows it's a bad business. They will often not just pay a low price. They might actually pay a really low price. Ford in 2009 thought their loser business was Jaguar Land Rover. So you know what they did? They gave it away for almost nothing to Tata Motors. They just want to get it off the books. And then they heaved a sigh of relief. 15 years later, Jaguar Land Rover is the engine that drives Tata Motors. It's what drives the value of the company. Often selling your worst businesses is in fact the worst investment decision you can make from a pure net present value standpoint, because people won't pay. You know what your best candidates for people paying more than your value would be? Go ahead. I'm sorry. You had a question. Absolutely, right? I mean, in a sense, I think often the imperative to try to get rid of things is such that, especially when a new CEO comes in, they would clear the table. They would sell the bad businesses, because this way, on a cosmetic level, it looks like they're running a better company. Nobody seems to stop and ask the question, what's the price I'm getting for this business? So which of the businesses do you think people would pay too much for? Because remember, that's how you make money. The price has to be higher than the value, right? Let's say your star business is your AI business. It's earning well above the cost of capital, right? It's also the business most likely to be the business where people will overpay for. Divestitures, just like acquisitions, it all depends on the price. Getting rid of bad businesses does not make you a better company in terms of creating value, because you're not going to get your money back. It's too late. You got to ask, what's the price I get? And if the price is too low, you might be better off keeping the bad business and earning what you can on it. It's making money. It's not losing money. It's just not making enough money. You regret the original investment you made, but you can't make up for it. Final question, and this is kind of, I mean, I wrote this a decade ago when Google was a star. Let's see if your answer would be different now. Say Google has $60 billion in cash, right? And it decides to return 45 billion of that cash in buybacks. Okay? Will you, as a shareholder in Google, be better off or worse off after the buyback? And what will it depend on? Ed? First is, it depends on whether you trust Google, right? They're not going to let you look at the projects. You're saying, do I trust Google? 10 years ago, the answer would be absolutely. Today, kind of shaky, right? Because every project that Google has taken after that search box, I mean, the rest of the alphabet is like the 7 dwarfs, right? You look at them, it's like 94% of my revenues come from the search box, 0.1% comes from this, and 0.7, they're all money losing, you know. Google doesn't have a great track record after the search box. Nothing they've done after the search box has paid off. And now, of course, you have this added burden of, were you asleep at the switch when AI took off? I mean, I don't know what the inside story is. Maybe we're overreacting. What I'm saying is 10 years ago, Google might have been trusted, and you say it doesn't matter whether you return it or not. Today, my guess is a buyback would get a very positive response. And I wouldn't be surprised if in the next few months you actually did see a buyback. That would be the sensible thing to do, because Microsoft did exactly the same thing in 2004. It's when people started to lose trust, they actually did a buyback saying, look, you don't trust us, here's a cash back, which is the sensible thing for companies to do. So as you watch the FANGAM stocks, don't be surprised, especially among the ones that lag, that you start to see buybacks as a way of saying, you don't trust us with the cash, here's the cash back. So lots of things on the agenda. Let's go back to the last few pieces of acquisitions. Remember, I was trying to convince you to get to pay more than 60 million, which is the value of the target company. I tried to get you to use your cost of equity and you refused. Then I tried to say, look, you have cheap debt. No, couldn't that bring that? And you said no. Then I tried to get you to pay a 20% control premium. And you said, not so fast. Then I said, what about synergy? And you said, show me the numbers. I'm getting a little desperate here. So I'm going to try a couple more ploys. I said, look, let's stop talking about intrinsic value. It's a distraction. We're in a market. Who knows what the intrinsic value is? We'll tell you what people typically pay for companies in this sector. So I do a pricing. I pull up companies. In this case, I pull up not every company in the sector, but what I call transaction multiples. Basically, only companies that have done acquisitions. So I want you to file that away. So there are 25 companies, but I picked the 7 acquisitions in the sector. And I say they're paying 5 times EBIT in those companies. Your EBIT is 20 million. If you remember the target company, 5 times 20 is 100 million. Let's ignore the DCF. This is what people have to pay to do an acquisition. It's a pricing argument, right?
Professor, we cannot see the screen.
Oh, thank you for letting me know, right? How about now?
Yeah, we can.
Okay, good. So 5 times average pricing argument. I said it's okay to make a pricing argument, but I think there's a problem even on a pricing basis with this argument. I want you to think about it. What goes in this argument? My comparables and my multiple, right? It's always an issue in pricing, but the way I've constructed my comparables and the way I pick a multiple, I'm going to argue, are much more problematic when you do acquisition pricing than in traditional pricing. So let that file away. If that doesn't convince you, I will use a word that bankers like to use to convince people to do deals. I said it's accretive. The deal is accretive. What does that mean when I say a deal is accretive? My earnings per share goes up after this deal is done. That's all accretive means. Dilutive means my earnings per share comes down. It's an absolutely stupid reason to justify an acquisition, but it seems to be magical. There are companies who seem to believe accretive deals are good, dilutive deals are bad. We'll talk about what kinds of deals are accretive. It's a purely mathematical effect and why it's not a meaningful measure of success. So when you think about pricing, let's start with the pricing question. In statistics, we sample all the time, right? When you did a peer group for your company, you sampled. You made choices about what geographies, what market gaps, and sampling. You have to do it. Otherwise, our universe is too big. Is this a sample? Yeah, the sample I've done, but it's a sample of transaction multiples. Is there a bias there? What do we say about acquisition? You pay a 20% premium. I've selected companies that did acquisitions. This is not even a pricing. It's a pricing based on a subset that is going to deliver. It's like, I'll give you an example of a bias sample. When is the coronation? I know you've got it on your calendar. I'm sure you want to watch the damn thing. You know, there is a coronation, right? This guy, King Charles, is going to become king of England, and there'll be royal. Now, it's going to be on TV. Let's suppose your sample is people who watch the entire coronation on TV. And then you ask them, what do you think about the royalty? What do you think the answer is going to be? We love the royalty, 97%. Why? Because the only people who watch the coronation all the way through are people who are 75 years old who love the royalty. It's a sampling bias. If you pick a sample of transaction multiples, you are creating bias. You're going to push up your numbers for all the wrong reasons. And this notion that you can push it off and say, I'll do it in year 5, is that still a problem? Yes, it's a problem. The 5 is the problem, not whether you do it now or not, because the 5 came from a bias sample. So if you're going to do acquisition pricing, get rid of the bias. And the easiest way to get rid of the bias is if you're pricing a software company, rather than look at only other software companies that got acquired, look at all software companies. Do a full pricing. Because if you want to pay a premium, then you got to say, why am I paying the premium rather than this partial pricing of focusing on a subset of companies? So is everybody clear on the bias coming in when you use transaction multiples and why you need to expand the sample to look at companies that were not in transactions, because otherwise you create bias in the process? But that's really not an acquisition, right? You price buildings based on it's a forward pricing, right? It's always been a pricing game. It's never been about value, which also means that when it's all pricing all the time, what are you going to see in the market? You're going to see booms and you're going to see busts because it's all driven by mood and momentum. So real estate reaps what it sows, right? You create a pricing game where nobody's asking questions about intrinsic value. Is the rental income enough to sustain the price? Sooner or later, you're going to overreach. So don't be a lemming just because everybody else is doing it. No, it's because the price that other people pay is 5 times EBIT is not a good reason for you to do it. The word accretive is kind of meaningless. And here's why. Let's think in terms of PE ratios, right? You're a company with a PE ratio of 10. What kind of company would you have to buy in terms of PE ratios for your acquisition to be accretive? Companies with lower PE ratios than yours or higher PE ratios? Lower PE ratios, because if you're a company that buys higher PE ratios, you're essentially going to lower your earnings per share because you're paying 20 times earnings for the other company. So if you tell me that accretive deals are good, you know what the follow through on that is, right? Anytime I buy a company, the PE ratio less than mine, it's a good deal. And anytime I buy a company, the PE ratio higher than mine, that's a bad deal. That makes no sense to me. Because if you're a company that's trading at 40 times earnings, then you're going to buy everybody in the market, say, I got a good deal, I got a great deal. Okay? I think we should remove the word accretive and dilutive from M&A in general, because I think more damage gets done because people focus on those words. And in fact, there's a McKinsey study that actually took deals, broke them down into accretive and dilutive, and actually looked at the follow through to see, are accretive deals really value creating? They actually found the opposite. The dilutive deals actually created more value than accretive deals. I wouldn't take that to the, so I'm going to do only dilutive. Don't go to the other extreme, but it shows you that how accretive tells you very little about the deal. You know the logic though, that allows accretive deals to look good, right? The logic is I traded 20 times earnings. My earnings right now are $2 per share. I'm going to do this accretive deal, and what does it do? It's going to make my earnings go from $2 to $2.50. Now finish the logic. I traded 20 times earnings. 20 times 250 is 50. My price is going to go up 20%. Where's the flaw in that logic? Why did your earnings per share go up? Because you bought a company with lower P, right? Either because of lower growth or higher risk. Now you create a combined company with that company part of you. You still think you're going to get 20 times earnings after you do this? I don't think so. But as long as you keep this fixed PE and you apply it on earnings per share, accretive deals are always going to look good and dilutive deals are always going to look bad. Now, so I'm now at my wit's end. I've tried everything I can. So I hit you with my trump card. I said, no, you're being very, very difficult as a negotiator. So I have to tell you, just between you and me, your CEO really wants this deal to go through. So you might come in and say intrinsic value of 60 million, but you see, and what I'm trying to say is sometimes as a negotiator, you're completely undercut by the fact that somebody above you wants this deal to go through. And if that is the case, you're done. There's nothing you can do to stop the deal. The other argument you'll often hear is everybody else in my sector is doing deals. If I don't, it's called a defensive acquisition. You're doing it because if you don't do it, you fall behind everybody else. Everybody else is overpaying. Everybody's consolidating. If I don't do that, then I'm going to be in trouble. I don't have an easy answer to either one. I mean, we know that premiums paid on acquisitions are affected by CEOs. You know, of all the things in behavioral finance that we've isolated that are dangerous in investing in corporate finance, the most dangerous is overconfidence. Of all the things that get investors and companies in trouble, it's overconfidence. And we, in a sense, pick CEOs who are likely to be overconfident people, right? I tell, when you think about the kinds of people who become CEOs, they're the kinds of kids you hated in high school. Who actually know very little, but act like they know 10 times more than they do. There's a lot of bluster. They rise through the ranks and they become CEOs of companies. What's the essence of overconfidence? You look at a company and say, I can fix that company. You pay a premium and you say, I can deliver the synergy. It's actually a study that was done, I think 20 years ago, that correlated premiums paid on acquisitions to a bunch of variables. And one of the things it correlated with is against the ego, the size of the ego of the CEO of the company. So how the heck did they measure the size of the ego? They actually they counted the number of press mentions of a CEO's name and hypothesized that the more often you're mentioned in the press, the bigger your ego. It actually worked really well. And it doesn't surprise me. Overconfident CEOs often carry this acquisition gene no matter where they go. So if you have an overconfident CEO, you're, in a sense, almost predestined to overpay for acquisitions. As for defensive acquisitions, I've never understood the logic. You're saying you're going to overpay because everybody else overpays. You're saying the only way you can survive in this business is by doing bad acquisitions. You know what my response is? Why do you stay in this business? Why not just liquidate yourself and go away? We talked about decline. When you have businesses where the only way you survive is by overpaying and doing bad acquisitions and you consolidate, maybe the better option is to not stay in the business. Say, you guys play the game, we're going to liquidate ourselves and leave this business. Because otherwise you're going to end up throwing good money after that. Final piece is the piece about accountability. Yeah. HP can be almost a poster child for a company that overpays, the company that every 5 years would then a corporate governance problem, then they'd have an overpayment problem, and then they take a write-off of $8.5 to $10 billion. Yeah. And this was actually, I'm going to highlight one particular acquisition. This was like from almost 15 years ago. So HP has been trying to reinvent itself now for almost 20 years, right? Because its core computer business is dead. It's gone. Their printer business was their only cash cow, but they weren't happy being a printer business. It was not. I mean, they were HP. This is a company that invented venture capital. The guy, in a sense, at the birth of Silicon Valley. So they've been constantly trying to reinvent themselves. So in 2007 or 8, somewhere around there, they bought this British company called Autonomy. It's like an accounting software services company. And they paid $11.1 billion for the company. It's a company that was trading at about 5.9 billion before, so they paid a premium of 5.2 billion. So essentially, I tried to build up to that number. And essentially, this is just a very mechanical way of building up to it. The book value, pre-deal book value of equity of Autonomy was about 2.1 billion. They bought in accountants who adjusted the value. Remember, they write up the values of assets, got to 4.1 billion, the market at 5.9 billion. And then HP pays an extra 5.2 billion. Why? Synergy, control, all the magical words. And at the time they did this, everybody else, this is one of the few acquisitions where everybody said, that is way too much. So the CEO of HP at that time, a guy called Leo Apotheker, was actually in New York talking to equity research analysts. And they must have asked him, why did you do the acquisition? I'm going to read his words using his own words because I can't keep a straight face while I read these words. I have to look in the other direction. He said, this is addressing the conference. He's talking about the acquisition. He said, we have a pretty rigorous process inside HP that we follow for all acquisitions, which is a D.C.F based model. We leave it at that, right? We know there are good DCFs and bad DCFs. So the very fact that he did a D.C.F based model tells you he knows nothing about DCF, right? And he referring, of course, this is journalist talking, referring to discounted cash flow valuation as standard. It's not a methodology, it's a way of thinking about value, right? It's what drives it. And we try to take a very conservative view. I'm very impressed with a conservative view, came up with the 5.2 billion. And then he should have stopped because he kept going. Just to make sure everyone understands, Autonomy will be on day one accretive to HP. That settles the whole thing, right? It's an accretive deal. Just take it from us. We did the analysis at great length and great detail. We've paid a very fair price for Autonomy, and we get 3 greats in one. Lot of greatness going on here. 1 year later, this happened in record time. The deal unraveled. HP blamed it on accounting problems at Autonomy. They said that's the only reason the deal came apart. So when the deal came apart, I decided I wanted to assign blame because they actually wrote down the 11.1 billion to 2.3 billion. That's an $8.8 billion write-off. Somebody should lose their jobs for this, right? So I want to say, let's see who should be held responsible. So I broke it out. I said, there's 4.45 billion. This is HP's fault. The CEO promised all these fixes. He didn't make it. He should not only lose his job, we should claw back his bonus. And if we can go after his house, go after the house, his car, his investment funds, whatever it is. The secondary culprits there are, of course, the deal makers who put out the projections. I would like to see their deal fees returned and make sure that they never do this again. It is true accounting and propriety cost about 1.7 billion, and the culprit for that is Deloitte. Maybe we can get the 1.7 billion back from them. And if you look at the remaining write-off, this has to be HP actually running the company worse than it was run before. So lots of blame around here, right? You know how many people actually got held responsible for this? Do you think Deloitte returned the accounting fees? No. Do you think the banker said this was a bad deal? Sorry about doing this. We shouldn't have done the projections. No. Leo Pothiker was retired as a CEO, but he kept his bonuses. No. This is what I mean about lack of accountability. How do you make an $8.8 billion mistake? And then throw up your hands and say, no, I don't know how that happened. Maybe the janitor did it. He slipped away in the middle of the night, bought the company for 11.1 billion when we weren't watching. So now it's a pretty negative view I've given you of acquisitions. I'm going to give you a glimmer of hope. You're moving to M&A. So let's say you end up at a company that is either an acquisitive company or you end up working in acquisitions. And you say, look, I want to at least create some value here. So I'm going to give you some choices about where you can create value from acquisitions. And some of the choices are pretty easy. So you can tell me which one you would pick. So your objective is to create value from acquisitions. Would you prefer to be a sole bidder or be in a bidding war? It's an easy one, sole bidder. Would you like a public target or a private target? And the reason being, public targets start market price plus private, you negotiate the value, so you get to know what's in there. Would you prefer to pay with cash or pay with stock? It's a tricky one. Depends on what, Ed. If you think you're overpriced as the acquirer, you might want to use it. It's gaming though, right? Because the minute you tell me you're going to pay with shares, I'm the target company and I realize you're paying with shares, you've sent a signal to me about what you think with your shares. So guess what I do to the premium when you offer? So this is going to be determined not just by am I overpriced, but what's going to happen to the premium. So we look at the net evidence on it. It's kind of mixed depending on big deals versus small deals. Would you prefer to go for a small target or a big target? Mergers of equals or mergers of unequals? Much better chance with a small target, right? Because if you make a mistake, then it's not going to kill you. At least you have a chance of fixing it. And finally, would you prefer to go for cost synergies or growth synergies? Cost synergies, right? Let's see if we back this up. Let's start with sole bidder versus bidding war. And it was an awful looking graph. I directly took it out of the paper. Shows you how primitive graphs are still in academic papers. Right? This is a graph of what happens to two players who are in a bidding war. I'll tell you up front, one is a winner and the other is a loser. What happens to the stock price? So time period 0 is when the war is won by one side or the other. So one of these is the winner's stock price and one of these is the loser's stock price. Which one do you think is the winner's stock price? Yeah, that's the winner's stock price. There's a loser. So if you're in a bidding war and I'm a shareholder in the company, I'm getting down every night and say, please God, let them lose. No, this is basically the two bidders for the company and what happens to stock prices around the time a target is actually pegged. So being the winner in a bidding war is like, but we know this from economics. There's this idea called the winner's curse. Have you heard of this? You go to an auction, you really want something. So you keep bidding higher and higher and you win the auction. You should always have mixed feelings about winning. Notice that everybody around you is celebrating while you are for a different reason. You're celebrating because you got that item you wanted. Everybody else is celebrating saying that guy paid too much. The definition of winning often means outbidding everybody else. So my advice is if you get in a bidding war, just drop out. Don't even fight this out to the end. Why expend the resources? Let somebody else play the game. When you look at cash versus shares, it seems to depend on whether you're doing a small deal or a big deal. So the way to read this is there's cash, there's stock, combo, and this is based on the size of the deal. As less than 6% of the acquiring company, 6 to 10%. So the larger the number, the bigger the target is relative to you as a company. On really small deals, so the blue part is the really small deals, you can see that using stock is much more value creating than using cash. So if you're a big company buying really small companies, there you can use stock as currency and it seems to work better than cash. As the deals get bigger though, the gaming seems to work against you. So when you have a $100 billion company trying to buy a $50 billion company and the $100 billion company decides to use shares, The gaming effect is the $50 billion company pushes up the premium saying you're paying in shares. That must mean you think you're overpriced. So we're going to charge a 15% higher premium. Yeah.
They're not going to select advice, but you must always pay in stock for massive acquisitions.
Not necessarily, right? I mean, because in a sense, you could borrow money, you can, no. And really big ones that might be that just the size effect itself is dominating, but that's possible. So it might not be just the share effect, the fact that almost every big deal creates a size effect. And focusing on private companies is a clear winner over public companies. So basically the way to read this is, again, small to large deals in every single segment. The green, the red is a private, the blue is the public. But there's an even better strategy than actually private targets. It's divisions of public companies. Why? Because, as I said, CEOs do some really stupid things to clear the table. The Ford Jaguar Land Rover story, right, that you play out. You approach companies, especially at a moment of weakness, you might be able to get a bargain. Yeah.
That's why spin-offs do so well as well.
Exactly, right. So I think in a sense, you're seeing this play out. So is it possible to create, and finally, cost synergies versus growth synergies? There's a McKinsey study that looked at the percentage of the time that synergies get delivered. So to your right, you see cost synergies. Out of the, I think, 92 cases, 36 plus 61 of the cases, you delivered 100% or more of the synergies. In contrast, if you look at growth synergies, about a third of the time you deliver the growth synergies, a lot more failures on growth synergies. So is it possible to create a strategy that creates value if you stay disciplined? And you know how difficult it is to stay disciplined as an acquiring company? You can start small, you're initially disciplined, but you get bigger and bigger. It's almost, you can see the seeds for the thing blowing up because you need to know when to stop, but you can't stop. This is the only way you know how to grow. This is the Cisco story, right? A company that was, I mean, Harvard Business School used it as a case study. This is the way you're supposed to grow with acquisitions. And it's usually a death knell for a company when you get used as a case study in Harvard, because that greatness, which drove them from 90 to 99, essentially almost destroyed them. John Chambers, same CEO, same management. You could see how the strategy turned on its head as the company went from 4 billion to 400 billion. Acquisition-based strategies don't scale up well. And you can see why, right? As you get bigger, you got to do bigger acquisitions, so more acquisitions just to get the same growth rate. So if you're going to do acquisition-based strategies, I would say do it, but every year you got to say, is it time to stop? Are we hitting the end of our tether in terms of what we can do with this? So for acquisitions to work, discipline is the key word, and discipline is often lacking. So if you can find a disciplined company that can do acquisitions and stop at the right time, it's a value creator. Many of you are valuing companies, or some of you are valuing companies that have grown primarily through acquisitions. They have a history of success. What I'm saying is when you project out these numbers for the next 5 years, the next 10 years and beyond, you might want to bring that success level down because history suggests that as they get bigger, this is going to get more difficult to scale up. It's easier to scale up organic growth than it is to scale up acquisition-driven growth, just because of the magnitude of the companies. Any questions on acquisitions? And if you really want this process to work, make sure you plan for acquisitions before you do them. Hold somebody accountable for delivering on those numbers. The banker doesn't care, right? He's going to give the projections, or she's going to give the projections, get the deal done, and they're out of the door as fast as they can get. But you're stuck with this company. This is your shareholders' money. You cannot tell me Goldman Sachs is responsible for your screw up. Because ultimately, you made that final choice. Yes, go ahead. Yeah. Well, because you didn't have to pay. So in a sense, what's a winner and loser? You're bidding for a company. Stock price is 50. You bid 75, I bid 80. You bid 85, I bid 90. What's the definition of losing? You stop bidding. It's like being on eBay. I win, right? But I now have to pay $90 per share. What did you have to pay? No, you walk away the rest of the deal. So you don't have to buy the remaining shares, right? So when you think about bidding wars, losing basically means you stop paying that outrageous price because you're no longer part of the bidding war, but I have to buy the remaining shares at the price that I won at. And if I'm paying too much, guess how it's going to show up? It's going to show up as a much lower stock price because I'm overpaying. Because you don't have to pay any more money, right? So let's say you bought up for 10% of the shares. If you won, what did you have to do? Buy the remaining 90% at that high price. Because you lost, you actually will now make money. Do you know why? Because you're going to sell to the winner at the $90. You actually get an escape hatch. That's amazing. In eBay, if they allowed me, that'd be great to have an escape hatch where I say, you know, I kept bidding, you could pay me the high price. It doesn't work that way, but that's what you get in a bidding war, right? Yep. That's just the yeah, it's just the market cap. The market cap being greater than it's a value of growth, right? So basically, the accountants can write up the value of existing assets. So even if they do it right, they're not going to get to the market value. To the extent that the market and assessment of expected growth, that extra 1.3 billion was what the market was attaching over and above the accountant's estimate of fair value. So think of accountants writing up all your existing assets to fair value. The market's paying a premium on it. The more mature you get as a company, the smaller that premium would be. Here, there was some growth. The market was paying a premium for that growth. I'm not even passing judgment on whether that number was too high or too low because I have 11.2 billion. That's beating the market by 5.3 billion. It doesn't incorporate growth, right? Because you can only fair value. And that's why fair value accounting can never be a direct competitor to market cap. Maybe for companies which have zero growth and at Kraft Heinz, maybe I can get them to converge. And that's why I don't even know what the point of fair value accounting is, to be quite honest. What are we trying to accomplish by spending all these resources by marking it up to market? When 80% of it, I mean, let's say I allowed you to do this for Zoom or Snowflake, right? Your fair value is going to give me no indication of what the company's actually worth. So let's talk about value enhancement. I told you value enhancement and price enhancement are not necessarily the same thing. I'm going to show you the results of two studies from a long time ago, separated by about 5 years to illustrate this point. The first study was done in the late 90s. Title of the paper, I think, was A Rose by Any Other Name. And what they did was they picked a group of companies, I think 60 plus companies that changed their names in a very specific way. It's the peak of the dot-com boom. What did they do? They added .com to their names and they changed nothing about their businesses. Because companies that change their names and change businesses is different. But here, same company, you just added .com to the back. And it was extraordinarily common in the late 90s. A company, a steel company, would add .com to their names. What's a .com doing? No, just .com. But you can see why they did it, because when this study looked at what happened to stock prices when you put .com in there, the stock prices jumped. And these are small companies. They jumped 100%, 150% because you now called yourself USsteel.com. You don't even know what that means, but it goes to .com. You think that's absurd. But it also means that this entire class might have been a waste of time, right? We should have been talking about better names for companies. Maybe AI in your name would make a big difference. Darden Restaurants AI. I don't even know what that means, but you know, so that looks good. I'll add another 20% to value. The problem is, if you play this game, what the market gives, the market will take away. So the second study is just a few years later. But now the .com boom is bust. And this study also looks at companies that change their names. You know what they did? They took .com out of their names. Because by now, .com was a contaminant. People didn't want to be around .com stocks. They'd seen the failure rate. And there you go, stock price goes up again. This is an incredible game. You put a name in, you take a name out, you put a name in, you take a name out. But you can see that this is what price enhancement is about. You're playing games looking at what does the market like, and I'm going to add that to my company. And you could succeed. You could push up your stock price 30%, 50%. Pick a name very close to Tesla. You know how many times people mistype symbols and buy the wrong company? Make it TLSA. Who knows how many millions of shares you will sell before people realize, oh my God, this is not Tesla I've been buying for the last 5 years in my portfolio. Okay. So when you think about value enhancement versus price enhancement, you can see price enhancement requires that you play the pricing game. I don't know how to play that game. It keeps changing, fads change. So I'm going to focus on value enhancement. And value enhancement is surprisingly simple. To enhance the value of a company, I need to change something fundamental, right? There are only 4 things I can change. I can change the cash flows from existing assets. So that's my first stop. Can I extract higher cash flows from existing assets? Second stop, I'm going to look at growth. Can I increase my value by changing my policy on growth? And it can be in one of 2 ways. Either I'm reinvesting too little and I'm a good company, I have great projects I'm leaving behind, but reinvesting more will increase value. Or I'm a company that's reinvesting too much. You know what I mean by that, right? You're taking projects that earn less than your cost of capital, in which case, what will increase value is actually reinvesting less and taking the cash out of the business. So that's the second stop. Third stop, maybe I can lengthen my growth period. Remember, during the growth period, I'm earning above the cost of capital, right? Maybe I can find ways to extend that period from 5 years to 10. It's another way of saying, maybe I can build new competitive advantages, barriers to entry. And the final, of course, is maybe I can lower my cost of capital. What's the standard thing that comes to mind when you think about lowering cost of capital? Change the mix of debt and equity. But I'm going to argue it's one of 4 things you might consider to lower your cost of capital. So let's start with the first of those. Trying to get more cash flows from existing assets. So I'm going to start with words you often see in many restructurings. There's going to be a lot of cost cutting around here and more efficient operations, assuming you mean what you say. And the reason I say that a lot of companies can talk the talk, but they never carry through. What I hear is you're going to have higher margins, right? That's what cost cutting is. If you have assets that are losing money, that you expect to lose money forever, shut it down. You don't even have to divest them. Just don't keep them going. You're saying, why wouldn't somebody have done that already? Why do we have Aaron Hicks on the Yankee payroll still? Because the guy who signed him still, right, is the Yankee manager. Sunk cost, right? Once you make, the people who make mistakes will, this is the reason people don't sell losers on their portfolio. There's consistent evidence that people actually start to go blind on losers. They don't even see the stock anymore. They can look through it. I don't see it. I don't see it. Because as long as you don't sell it, you're not admitting to a mistake, right? Sometimes shutting a business down is an admission we should never have been in that business. But shutting that business down will almost immediately create a pop for you because you're taking that loss out of the bank. The third is going to sound mildly unpatriotic, but I'm going to say it anyway. I have never viewed it as the objective for any company to maximize taxes paid to the government. Maybe you think differently. Now, let me fully cover myself. Within the framework of the law, I want to minimize the taxes I pay. So what can you do? Well, if you think about, before 2017, when the US tax law changed, you did see US companies try to move themselves out of the US because their global income no longer got taxed at a US tax rate. And we talked about Pfizer, Allergan. That was the motive there. But you don't even have to do any contortions if you're if you're a company in multiple countries, right? Because what transfer pricing is? There's an entire ecosystem of people who do what's called transfer pricing, which is really, how do we minimize our taxes by moving things around? They'd like to frame themselves as doing more glorious things, but that's really what you're doing. And how does it work? You have a German subsidiary and an Irish subsidiary. They have interactions with each other. So when the German subsidiary buys stuff from the Irish subsidiary, you make them pay high prices. Of course, you find an economic justification. What does that do? It takes income from the German subsidiary, transfers it to your Irish subsidiary, and essentially allows you to pay less taxes overall. You're saying, this is so unethical. We're walking on the edge here, but basically, if you don't think companies do this on every company has tax laws, people moving stuff. No. I'm not a great fan of risk management. I think, frankly, companies manage risk too much. One of the advantages of risk management, though, might be smoothing out income so you don't get those spikes in income that cause your taxes to go up. So you can try to increase EBIT, you can try to reduce T. You can see already it's a very mechanical thing. I'm going item by item, so what can I do? Now, some CapEx is for growth, right? So just let's say, but some CapEx is for maintenance, keeping existing assets going. If you can spend less on maintenance CapEx without affecting the capacity of production, well, and that's a fine line. If you cut too much, you're going to see equipment start to break down. It's an increase in cash flows. And to the extent that you have lots of overcapacity that you've invested in, live off the fat for a while. Essentially, there's no law that says you need CapEx every year, right? So if you've had overcapacity, you have 4 years without CapEx, you can still get cash flows from existing assets, but the depreciation will it's a gift that keeps on giving. So your first stop is, can I increase cash flows from existing assets? Now, when we think about restructuring companies, you can be restructuring companies across the life cycle, right? Where in the life cycle would companies have to be for this to be the primary place for value enhancement? What kinds of companies? Stable, mature, perhaps even approaching decline. This is where you're going to go, right? This is where the bulk of your value comes from, cost cutting. Let's talk about the second stop, because now we're going to go beyond that mature phase. Are there some growth companies that are badly managed? Absolutely. There's some growth companies that reinvest too little. Why? Because they have outlandishly high hurdle rates. In any sensible economic world where you're a market company, your hurdle rate should reflect what investors in the market demand on investment. No, your hurdle rate should never be 30 or 40%. If you're a US company, but you know why some companies have hurdle rates of 30 or 40%? Because that's what they used to earn on their projects 5, 10, 15 years ago. What does that mean? They reinvest too little. They're turning away projects that make 25%. You say that's too low. Yes, sir.
CEOs who add on premium with their hurdle rate, feels like a margin of safety.
Yeah. There's margins for safety, margins for bias, right? We know that people are over. So the reasons you add those on, the margin for bias, I'm okay with, because what you're saying is what the IRR I see on a capital budgeting project is a lie. When people say it's 14%, it's really like 9%. So I'm going to add 5. It's a very dangerous game, right? Because once you add the 5%, guess what the IRR person does? He finds new ways to create bias to make 14% go to 19%. I don't think it's healthy to play that game. But you're right. People said hurdle rates are too high a number, but the consequence might be you might be rejecting good projects. To them, your advice is reinvest more. Take that 25% return project, even though it's lower than the 30% you used to make, it's higher than your cost of capital. So in some companies, your advice is reinvest more. And that reinvestment can either be in internal projects or in acquisitions, as long as you meet the criteria of return on capital exceeding the cost of capital. But the more interesting case is when you get to the later stages of the life cycle of a company, and there are really no good projects out there. You can't earn your cost of capital, but the company keeps investing. There, your advice on growth will be invest less. For some of your companies, try this out. Make your sales to capital rate, make your growth rate in revenue 0% and see what it does to value. Your first reaction is value is going to go down. You might be surprised. And this morning, I had at least 2 people come into my office with companies where the higher they made the growth rate, the lower the value became. So what's going on here? What was going on was the sales to capital ratios of 0.5. The margins were small. They were basically investing in projects earning well below the cost of capital. And the model was telling them, just stop. Your value will be higher. Doesn't mean the company will. But for those companies, you can see value enhancement often means be less ambitious. It's a tough sell, right? CEOs want to hear stories. How do I get bigger? How do I grow? And you're telling them, no, you need to shrink. And here there's some evidence, if you're thinking about different ways of growing, and you're saying, where is my value added the greatest? There's some evidence that's accumulated. Some of the most interesting work on valuation, looking at actual empirical work, comes from McKinsey, because they have this proprietary database of all the clients they've tracked for 30, 40, 50 years. So it shows up in this journal that McKinsey publishes called the McKinsey Quarterly, which you can actually get a free subscription to. Get on their site, sign up, and you can get the article. So this is actually from a McKinsey quarterly article where they looked at the dollar value created by a dollar invested in different growth strategies. And they've ranked them from best to worst. So looking across a sample, I don't know what's in the sample, it's a proprietary sample, but here's what they saw. $1 invested in new product development across all their companies created about $1.75 to $2 in value added. So in terms of value creation, coming up with a new product by far has been the most lucrative strategy. Does that mean every company should go after new products? It's also the strategy. The winners get these huge amounts, and there are lots of potential losers. The second best strategy is expanding an existing market by finding a new use for a product or coming up with a way of getting customers to add on. Uber's most value-added proposition is to take their existing riders and find them to do something extra on the Uber platform, because that's pure profit. A dollar invested creates about 30 to 75 cents in additional value. So you want that number to be greater than zero, right? Because you're creating value. And then you get to the trickier ways of growing. Maintaining or growing shares in a growing market is still creating value because the market itself is growing, right? You get a buffer when the market is growing. Indian and Chinese companies have a significant advantage over European companies for a simple reason. Your core market is growing. You can afford to be sloppy and get away with it because the market itself is growing. And then you get to the bottom of the barrel strategies. One is competing for share in a stable market. It's never been a great way to grow. You know why, right? How do you get a higher market share in a stable market? You cut prices. You cut prices, your margins go down, you get the higher market share, but what do you have to celebrate? And you are surrounded by markets that are maturing, right? Restaurant business, the smartphone business, and you wonder, well, how do you grow in a market like this? And at the very bottom of the barrel, shouldn't be surprised, is acquisitions. By now, you already had the lead, and you can see why. It's really difficult to create value from acquisitions. We threaded the needle and talked about the ways you might be able to do it, but it's really, really difficult to do so. And in general, when people talk about growth, I think the stable is a way of bringing them back to earth, saying, you know what, most of the time, growth not only doesn't create value, it destroys value. So this is a percentage of companies that earn less than the cost of capital and more than the cost of capital in 2022. It's 1 year. I know it's all its caveats added. In 2022, 70% or close to 70% of companies earn less than the cost of capital. Only 31% of companies earn more than their cost of capital. Some of them have good excuses, right? I had a bad year. Some of them are young companies. Some of them blame accounting. But here's where those excuses run dry. Out of that 70%, 40% have had trouble making their cost of capital for years, a decade or more. This is well beyond excuses. Right? You're just in a bad business. There are airline companies that have never earned their cost of capital in their lifetime, ever. I think it was Warren Buffett yesterday was talking about the airline business. If you get a chance to read his quote, basically captures the fact that creating value in an airline has been almost impossible to do. Even the very best airlines barely make their cost of capital. So you can go for cash flows, you can try for growth. And with the growth dimension, you can see it's more your range gets wider, right? There are some young growth companies you might advise to grow faster by reinvesting more, and some older companies you might reinvest less. Much bigger circle of companies. Third stop, maybe I can increase the length of my growth period. On a spreadsheet, it's so easy to do, right? What do? You take 10 and you make it 20. That was easy. But in real life, to earn more than your cost of capital, you have to have barriers to entry, competitive advantages. I'm trying to find a reason for your corporate strategy class. This is where I have ended up. Is where in my numbers, this is where it shows up, right? You build up competitive advantages, it shows up as a longer growth period. I'm not a strategist, but I can think of at least 4 conceivable competitive advantages. The first is brand name. We know it is an enduring competitive advantage in some companies, but it's also a competitive advantage. We've seen companies waste away, right? It's not permanent. It's not a given. But to the extent that it lasts, maybe if you have a brand name, you can protect it. And if you don't have a brand name, you can try to find a brand name for doing something differently. But it's not for all companies, right? 80% of companies, this is not even on the realm of what can you do. A Walmart, there is really no brand name component. So let's talk about what else you could do. Maybe you can get the government to protect you from competition. That's nice, right? But be careful what you wish for. I mean, remember the old phone companies were protected from competition. Amazing. But why do you want to be a monopoly? What's a great thing? Everybody hates you when you're a monopoly, right? But how do you get back them? You charge them higher prices. You hate me, 40% more for you. It makes you feel a lot better. I'm hated. I might as well take it out of them. The only problem with being the phone companies, monopoly. And when you get to charge 40% more, you have to make a stop at the regulatory commission and they say 3% higher. You get the worst of both worlds. So if you're going to get legal protection against competition, if it comes with restraints on pricing where you can't take advantage of it, you might say, thank you, but no, thank you. Switching costs. You know what switching cost is? You want to make the cost of switching into your product as low as possible. And once people are with you, you want to make the cost of switching out as high as possible. You want to see it at play? Now, what phone company do you use? Verizon, AT&T, Verizon. I wanted to go to the AT&T office and ask, can I switch to AT&T? They will make life so easy for you. Say, well, I'll do it right here. Just give me, and 15 minutes later, you'll walk out with an AT&T contract. Just don't try to read the contract, because it'll run 15 pages in really small print. You know what the small print will tell you, right? You're now AT&T. It's going to be really difficult for you to leave. No, but can you blame them? Because otherwise I'll be switching Verizon to AT&T every month. This is a commodity to me. What difference does it make? My service is bad either way. Right? But you can see in businesses like this, I mean, self-service is a business begging to be commoditized, right? So you're going to try to find ways to make your business stickier. And this is one of those things.
You know, on here, economies of scale. Yeah, that's another moat that, say, Coca-Cola has around the business. We can start.
Which is what I think of as cost advantage. Cost advantages can come from lots of things. One can be from economies of scale. Walmart's advantage over other retailers for a long time is they did something on things on scale so much larger than everywhere. Home Depot wiped out local hardware stores because it can also be an endowed cost advantage, right? What's Aramco's big competitive advantage? That somebody gave them 300. It's not like the CEO of Aramco went and found this oil. Sometimes these cost advantages you're endowed with because you happen to be in the right place at the right time. You're a Peruvian copper mining company. It's not like you did anything magical, but you have a cost advantage. And you can use that cost advantage in one of two ways, right? One is you can charge a lower price than everybody else and get a higher market share. You can charge the same price as everybody else and end up, which one's better? You got to work through the numbers. I can't tell you up front because they're going to have different implications. And finally, let's talk about cost of capital. It's true. I can change my mix of debt and equity, end up with a lower cost of capital, but that's only one of four ways. Here's the second. If you mismatched your debt to your assets, you've created default risk you did not have to, and you perhaps have a higher cost of capital. You know what I mean by mismatch? Using short-term debt to fund long-term assets, dollar debt to fund euro assets. It's a fixable problem nowadays with swaps and derivatives. You see the effects of mismatch, right? SVB, classic example of what happens when you mismatch. So mismatching things stop. There are two other ancillary things you can do that make your cost of capital. Remember we talked about betas, we talked about what drives betas. So how discretionary is your product or service? If you can work at making your product or service less discretionary, in effect, you're lowering the beta for your company. By lowering your beta, you get a lower cost of capital. The other thing we talked about was fixed costs. If you're a business with a lot of fixed costs, you said your beta is going to be much higher. If you can make your cost structure more flexible, it's an indirect way of saying I have a lower cost of capital. What I'm trying to say is that there are levers on cost of capital which people don't even try. They're so caught up in the mix of debt and equity that they just stop there. But the end result is you're trying to come up with a cost of capital that's lower that can push up your value. So I want you to play CEO for a moment. I'm going to show you two companies from way back in time, and you're going to be in charge of what you're going to fix in these companies to make them more valuable. The first company is a German software company called SAP. It competes with Oracle. It's a B2B company. It sells software to other businesses. This is a valuation I did way back in time, 2005. I'm not going to go through the details, but I'm going to describe what the company was doing. And I want you to think about what you might change in this company, because that's what you care about. What are the levers you can move to make it more valuable? It's a company that reinvests about 57% of its after-tax operating back in the business. It's a pretty decent return on capital, 19.93%, well above its cost of capital. So it is clearly taking good projects. It is reinvesting, at least in 2005, it's reinvesting primarily in Europe and North America because those are the markets they're most comfortable in. But their return capital is well above their cost of capital. They're not a badly managed, badly run firm. So the easy fixes are gone, right? The cost cutting is not going to work. In fact, it's probably going to have the opposite effect. They're almost entirely funded with equity. Why? Because the people who ran the company, including the founders who were still big shareholders, did not like that. Primarily or not, almost entirely equity funded, growing, but growing primarily. So you're the CEO. What's the first thing? What's the easy first fix you're going to make? Borrow a little more money. Don't go crazy. No LBO. So don't go to the other end and say, let's do an LBO. That'll freak them out. But maybe use a slightly higher debt ratio, right? How much higher? Well, one of the things we talk about in corporate finance is coming up with the optimal mix of debt and equity. So in this case, we work out the optimal debt ratio. It works out to be about 30% debt. So the cost of capital is minimized. They have a solid rating still. So right now, almost no debt. What is that going to do? It's going to make their cost of capital lower. Everything else in the valuation is going to stay in it. But let's be quite honest, there's a wealth transfer happening when you do this, right? The value of SAP goes up, but where is that additional value coming from? It's actually coming from taxpayers, right? But the biggest advantage of debt is a tax advantage. You take that. So it's something that no LBO person ever wants to talk about directly. They talk about value creation. No, it's not value creation. You're doing your value transferring. You're doing it legally. So I'm not saying you should go to jail, but don't go around telling everybody how much of a value creator you are. Great, you got some tax advantages. Okay. So I'm going to try to fix the debt ratio. And unfortunately, when you don't know business that well, that's where you got to stop but I'm going to make at least a leap and say, look, maybe you can reinvest more. I'm looking at the return on capital they have relative to the cost of capital. Looks like they're stopping too soon, right? They're projects that make above the cost of capital. And especially given the fact that their focus seems to be in North America and Europe, my suggestion is perhaps you should be investing a little bit more in Asia. That's the next growth market. So here are the changes I made. 70% reinvestment rate, with much of that additional reinvestment happening in Asia and Latin America. Return on capital, I assumed, would stay at it, but that might be something to look at. Maybe the projects in those countries might have a slightly higher, lower return. I'd have to work it out. I did adjust the fact that now that you've got more country risk, I brought it into a higher risk premium, saying you want to grow in those countries, you have to have. But bringing everything together, the value I get is about 126 euros per share, as opposed to what? 106 euros per share. I know it's very simplistic, but in a sense, that's what restructuring is, right? Taking a dive into each number, saying, what can I fix? That difference of 106 versus 126, what should I call that? Remember that control card I held up and he put 20% in the back? Maybe it's not so bad. It is actually around 20% here. That difference is the true value of control. Things you can change that will make the value go up. Tough to find, right? It's so much easier, value and control, when you have a badly managed company than when you have a company that for the most part, like SAP, is well managed, but has some blind spots. Yeah.
A lot of this seems like a well-managed company, that's the premium that we're going to realize through these actions. So you could almost look at companies that are poorly managed and work out if they were to have different management, what would be the uplift in value.
Exactly. And it could be much, much larger than 20%, right? Yeah. In fact, I'll give you my favorite example. This is now a company that's all that's left is on the internet. You have the original Blockbuster store that's become this place that people visit as a, I don't know why you would do that. You must have an empty life. And you would say, I want to visit the very first Blockbuster. But I guess if you're a certain age, this is nostalgia that's driving you there. I don't think you can actually rent tapes anymore there. You just have to go visit, take a picture, and then leave. Right? But this was Blockbuster Because Blockbuster was an incredibly successful company in the 1990s. It was a roll-up, right? Because it was created by rolling up individual video stores, done very well. And then it had disrupted, just as it disrupted an earlier business, it got disrupted itself. By whom? By Netflix. Very first Netflix version. Remember, they used to mail out tapes and you'd mail them back. And then it was quite clear, and Walmart started offering that dollar rental where you walked in, you could rent a tape. So they were being assaulted from both sides. Netflix taking away some business. The problem is they didn't seem to notice. They kept opening 20, 30 new Blockbuster stores every year. It's almost like they were an autopilot. So if you look at Blockbuster, this was in 2002 or 3, their reinvestment rate was 26%. That's in new stores. They were earning a 4% return on capital. And the cost of capital was 6.17%. And so this is growing. The definition of insanity is you keep doing the same thing over and over. I mean, they're certifiably insane. They're opening new stores. Nobody's coming in. So they open even more new stores and say, I don't know why bad things are happening to us. If I made you CEO of Blockbuster on the day this happened, it's the first, and their debt ratio is 50-50. There's no advantage of changing debt mixes, and they're probably slightly over levered. What's the first edict you're going to pass when you come in as a CEO? Stop opening stores. That's the most value creating action you would take, right? It's not go and open more stores, find a new concept, just stop. I've always wondered with brick and mortar retail stores, why that's not the first thing you do is stop trying so hard. Let's take a look at what we do to shrink as a business. If all that Blockbuster did was earn the cost of capital, which either means finding new stores or stopping opening stores, the value that you get is $5 to $12.50. It's an amazing increase in value, 150% increase in value. And why is that increase in value coming from? Because they're trying too hard. They're trying to grow in a business that's value destructive. And getting out of the business or stopping it can add a significant amount of value. That's the next step, right? So you take the easy step first, and then you say, is there a core business we can say? The answer is no. And the pathway is let's go to zero. If the answer is yes, that you can find a group of maybe senior citizen homes where you put a Blockbuster outside, they have a video player still, they're fighting the streaming thing, they don't want this Netflix streaming through, they want to put a tape in the machine. There's a subset of people out there that say Blockbuster for really old people without streaming. Then what you do is you shut the business down and create that niche business around it. But in many cases, there is no niche business. I don't think Bed Bath & Beyond, even if you'd caught them before they went to the debt spiral, there's probably no end game. You could say they can save those 15 stores. JCPenney tried really hard, right? They said maybe there's a core business where people keep coming in. So if there's a core business, you will shrink down to that and make that your steady state. But if there's no core business, you shrink down to nothing, you shut the business down. But you do it in an orderly fashion, which is you don't let the bondholders force you into liquidation because then you're selling at huge discounts. You try to extract the best terms you can from, remember, many of your lessors want the sites back and you've locked it in for the next 11 years. Maybe you can negotiate a going away, say, look, we'll go away early. You can rent out to somebody else at a higher fee, but you can do it on your own terms if you can see the apocalypse coming.
Yeah. Not to open any more stores, what are you mechanically doing to the
you're making your reinvestment rate zero, right? So if I made the reinvestment rate zero, I'd get a value of roughly $12 right there, right? Just removing that zero and zero all the way through because I have a 3% growth. So not only am I destroying value for the next 5 years here, I'm destroying value in perpetuity. And I'm saying if I didn't do any of that, that's an extra $7.50 that I'm losing in value. That's how much value I'm destroying by trying to grow. Because basically, at that point, your existing stores, you can't do much about, right? You're stuck with them, but at least you've limited your damage to your existing stores. They will continue to earn less than the cost of capital. And there you can say, is there a way I can get to the cost of capital by shutting my 50 most expensive stores? I don't need Blockbusters in big cities. I'm going to shut them all down. The leases cost too much. So you can start to try to strip down and see if there's a stopping point, but it requires time. It requires that you not be pressured to have to do that. Yes. Some of them. So, a subset of activist investors, this is their core business, right? I'll be quite honest. Much of activist investing, you know where the value comes from? Comes from the liability side of the balance sheet. That's why I think they lost their way. If activist investing was really about fixing operations, I would be much more in favor of activist investing as it's played out. I think in fact, studies show 75% of value created, if you can call it that, by activist investors comes from changing the debt mix. And that's the reason I'm less, but remember, the overall economy does not benefit from that because that increase in value is coming from taxpayers. The economy itself is not benefiting. So you don't want investing that's focused on just the financial side of the balance sheet. You need operations, but that requires work, right? Do this, you need to understand the business. So the people who do this tend to be people who are sector focused because they understand the business. Barry Diller, for instance, knows the business he's going into. And when he says we can cut these costs, he knows what he's talking about. Whereas if an investment banker takes over restaurants, I know what costs to cut. Disaster ensues because he's cutting all the wrong costs. So it does require work. Lily, listen. I did say, as long as the return capital is equal to the cost of capital, remember, growth doesn't matter. So I could have made the growth rate 0 and essentially left. So you're talking about the next one or this one? Yeah. In this one, I could have made the growth rate 0. As long as the return capital is equal to the cost of capital, the value effect is going to be roughly the same. So in this case, if you can show me you can open new stores that earn the cost of capital, I will. But if you can't find that, I'll just say shut the reinvestment rate to 0, and you'll get a value per share roughly equal to $12.50. It's the same effect we saw with the terminal values. Once the return capital equates to the cost of capital, the value effect goes away. It depends on what happens when you shut stores. If you shut stores and you get nothing back, it might not help that much. But if you shut stores and you can actually get cash back because you shut the stores, it could potentially make the value even better because you're shutting your worst stores first, right? You're shutting the stores with the lowest return on capital first. You're making the return on capital what's left. So you're at least trying to preserve a core of your existing assets so they earn their cost of capital. It's more difficult, though, to back out of bad investments from the past because it's the same reason divestitures of bad businesses don't work. It's not like people are lined up around Block and say, I'll buy you a video rental store from you because they know it's not working. People are not coming in.
Is that 70% reinvestment rate? That just makes sense.
It's basically just maintenance. Right? Yeah. Let's talk about last piece today. Let's talk about the expected value control. So value control comes from changing the way business is run, right? But to do it, what do you have to do? You have to change the way a business is run. There's a probability that you can make that change. That probability can range from 0 to 100%. If you have an activist investor who's powerful enough to say, look, I can pull this off, it might, but when you talk about corporate governance, and this is where corporate governance comes into play. What is corporate governance? It tells you the likelihood that you can create change when change is needed. If you have weak corporate governance, effectively you're saying the likelihood of change in this company is low, which means the expected value of control, which is the product of the two numbers, is low. So if you have a badly managed, badly run company, you have a 0 chance of changing the management. You know what the expected value of control is? 0. You know the company could be worth a lot more, but you can't change the management. You're stuck with the existing management. So you're saying, how do I assess that probability? As an outside investor, when you're investing in these companies, especially if they're badly managed and badly run, you're almost implicitly also making an assumption of maybe change will come here. So here are some of the things that might affect why that probability will change. One is when in some countries, corporate governance laws have created more change because they made it easier for people to challenge companies. Europe, 30 years ago, you couldn't challenge existing management. Now the laws have changed enough that you can do it. The presence of activist investors. If nothing else, you don't have to like a Carl Icahn, you don't have to like a Bill Ackman, but let's face it, their presence in markets increases the likelihood of change. Why? Because you use that as a threat against management. You guys keep doing this. It's like the demon in the closet that used to scare little kids. I know you're not supposed to. Stay in your bed or the demon's going to get you. This is the Carl Icahns in the closet and he's going to come out to get you if you don't stop doing it. And finally, anytime, and this is interesting, anytime there's a hostile acquisition in your sector, it's almost like every management in the in that sector wakes up saying, maybe that could happen to me. So when you look at studies that look at the likelihood of change of management, it's actually interesting studies because they're based on this statistical approach called Probit, where you look at companies where management changes versus doesn't. Here are some of the common features you see in companies where management changes. Companies with, no surprises, companies with stock prices have gone down relative to the peer group are more likely to see change than stock prices have held their own or gone up. Change is more likely at companies after periods of stock price decline. Okay. Second, the structure of the board seems to matter to the extent that if a board is small and composed of outsiders, you're more likely to see change than if a board is large and not that independent of the CEO. Third, ownership structure seems to matter. It seems that CEO changes are more common in companies with high institutional and low insider holdings. And finally, change seems to be more likely in some industries than others. Right? Some industries it seems to be embedded in the process that management just stays on. I mean, one of my problems with technology is what I call founder worship. Okay? It's less now, thank God, than it was 10 years ago. But think of it, the peak of tech companies 5-6 years ago. How we viewed the Mark Zuckerberg and the Brins and the Jeff Bezos of the world, we viewed them as saviors. Essentially, these people could do no wrong, and that makes it much more difficult to create change. But things change, and now, of course, people are more receptive to it. So when you think about expected value of control, those are the places. So on Monday, I will bring your results together, and I'll do the last few pieces in the value enhancement, because in particular, I want to focus on the fact that every consulting firm, especially the ones for what I call cream consulting, the high price consulting, are doing a version of value consulting. The problem is if they showed you a discounted cash flow model, they can't charge you the $5 million a year and then the additional effects. So they each have seemed to have created acronyms, magical words. If you do this, your value will go up. And I want to kind of expose those acronyms to what they are: CFROI, EVA. I mean, every consulting firm has its own acronym, and essentially say ultimately value is value. You can't change the mechanics of value. These acronyms are shortcuts, and sometimes shortcuts create consequences. So I'll take EVA, an approach that most people don't use, just to show you what can happen when you get focused on a shortcut like EVA instead of looking at the overall value of the company. So I will see you on Monday, and you can put your numbers into the master list. I will use that to put the final presentation together.
Yes, this one from 50 to 70 reinvestments increase the value of $20. So that's value of
And also it's not static.
oh right. No, I don't mean the debt.
No, but two things are causing the value to go up. One is a lower cost of capital, the other is higher reinvestment.
So what is the with the value of control?
Okay. They're both put together at the value control because you're making both changes, right?
The reinvestment rates is decreasing the value of control.
That's not, that's it. The value control is the change in the value. Value control comes from the fact that you're changing the value.
Oh,
You're changing the company and making it reinvest more. In this case, it increases that. I'm not sure what your question.
this is not value of control, it's just value.
You are the one in control. You're making these changes. What does control mean? Right? Control means you change the company. That's all control means. And those are the two changes. So the results of those changes are.
Okay. For this one, for smaller companies, we need to add or stop.
There's more like logic why we acquire smaller companies, why is it better to use
Right. Well, first, there's a size difference, right? Larger the deal, the worse it gets for the most part. But small deals, if you look at cash versus stock, I think there are four choices, right? Cash, stock, combo. No, so that's basically the size of the deal. So the cash deals, the smaller deals using cash, you can get away with. But as the deal gets larger, so as the deal gets with cash deals, small cash deals, there's a data pair. But if you stock with
Yeah,
big
I
deals,
understand.
it starts to get really bad because people, when they see using shares to pay for it, start to charge a higher and higher premium. So with small deals, you use stock. With larger deals, you use cash.
Yeah.
Because we look across the deals, you're more likely to get a much more sensible premium if you use cash or really big deals. Right? Because otherwise people use it as a stick, using shares, many shares are overpriced.